Ladies and gentlemen, welcome to Canaccord Wealth Management's Summer Investment Market Update webinar. Thank you very, very much for taking the time to listen to Tom and myself go through our views on the market. It's a pleasure to have you here in slightly better circumstances than of late, with, dare I say, England actually progressing to the final and us doing quite well in the cricket as well. Apologies to all non-English members of our audience. I'm joined by Tom Becket, who I've had the pleasure of working with for the last 2 years and a little bit more actually now, and we'll go through our views on the market. We really want you to leave this webinar with a really firm view of our positioning in the markets, how we see things going forward, and of course, in these interesting times, some insights into our take on politics, the markets, and economics. Now, Tom, I'll start with you, if I may. Tom,
of course, thank you.
Tom, welcome. And Tom has been following England's football travails, I should say, over the last 25 to 30 years. When I say following, I mean following by travelling to see them play in various tournaments. So obviously he's been out and about in Europe quite recently. Tom, your take on Euros after the great result yesterday?
It was better. There's no doubt about that. It was from quite a low bar, but the rules of both football tournaments and indeed investment markets is to try and get through, keep winning with as little fuss as possible, and then have a good end result. And let's be honest, the final on Sunday is a coin toss. As you pointed out, I've been watching England play football for nearly 25 years now. So there's been a few downs. There's been quite a lot of downs, but a few ups. Let's hope that Sunday is one of them. But like any sensible investor, I am going, but my flights were cancelable. My hotel was cancelable. I was trying to line up someone in Rotterdam to buy my ticket off me in case we didn't get through. So fortunately, that's not the case. So let's hope it's a good summer for sport and of course, a continuation of the good recent times we've seen for financial markets.
Thanks, Tom. Yeah, and important to have that insurance in place in financial markets.
Always hedge your bets, Richard. Diversification is the way forward.
Indeed it is. So there has been an awful lot going on in the last few months since we last updated our clients. Do you think anything's really changed in our base case for 24 and perhaps a little bit beyond now?
No, I think we do need to draw a line between the experiences of what will happen this year. I think so far so good with regards to the views that we outlined for everyone on previous webinars, and of course through the various mediums of communication that we offer here at Canaccord. So far things have fallen into place as we expect them to. I think we need to start thinking about next year as well. My suspicions are next year might be a bit more difficult. Doesn't mean we can't make money. I just think that after things like the US election, there might be less impetus for the economy from free spending governments. But let's leave next year to one side for now and just think about the rest of this year. Things are broadly still moving in a supportive direction for investors. As you know, at the start of the year, we outlined a picture of slowing economic activity, but still positive. Global recessions are very rare, fortunately. We didn't expect to see one this year. It's been oft-predicted, but it's been kind of a waiting for Godot recession. It never really has materialized, despite many people thinking it would do. And whilst the US economy is slowing, at the same time, we're seeing a minor improvement in China and a similar improvement in Europe, which means that global economic activity at this point in time is in line with the expectations we outlined for solid but unspectacular. Now, economic activity hasn't been the problem for the last few years. In fact, you could argue that the economy being too hot at various times was a bigger problem than slow economic activity or turgid economic growth. A bigger problem has undoubtedly been inflation, but there again, you might not be feeling it in your wallet quite yet, but we are in a situation where inflation is also tracking along the path that we outlined at the start of the year. We are seeing disinflationary tendencies. That's different to deflation. Deflation would be outright falling prices. What we're seeing is prices go up at a less pernicious rate than they were previously. And that's also good for financial markets. You know, that was really the big problem in 2022. The inflationary spike that we saw led to significant interest rate cuts. And our view was that this year we would see the opposite. Disinflation rather than outright deflation. And that would allow central banks around the world to cut interest rates. And I'll come back to this as we talk about bonds later. But again, we're seeing really the path that we outlined at the start of the year. We've seen the central banks of places like Canada, Sweden, Switzerland, to name but a few, cut interest rates already. The ECB in Europe has followed recently as well. Much more important for our client portfolios and, of course, your own personal financial situations with what we see from the UK MPC and indeed the US Federal Reserve. And we expect both of them to cut interest rates in the next couple of months as well. Again, more on that later. But again, this is symptomatic that the path that we set at the start of the year has broadly come true. Now, perhaps a little more controversial than those views, and a bit more difficult as well, was the views that we outlined for financial markets. But we expected at the start of the year to make money from both sides of the asset allocation equation: fixed interest or bonds, equities, stocks and shares. And so far this year, it's been a case of portfolios performing well because both of those engines have been, if not firing on all cylinders, they have been firing, and that's been a positive. So we expected to make money this year. That has been the case. The recovery that we've seen in place in portfolios since the nadir of the global financial market crisis in late or the autumn of 2022 has continued to progress. Long may that continue.
Thanks, Tom. Now, you alluded to elections, and of course, just a week ago today, we had one of those here with a pretty in-line result from expectations. Do you think the new Labour administration will mark a shift in the trajectory of the UK economy? What's your view on that?
Well, it's interesting. This is quite fresh in the mind because I've just been writing our latest investment outlook, which I hope at least some people read. And I was talking about how most of the questions that we get from clients are around politics. And politics will be important, no doubt about it, for your own personal financial situations, particularly around tax in the future. And I'm sure we'll get questions on that. But in terms of the economic mix and in terms of the outlook for markets, I remain unconvinced, as I'm pretty sure you do as well, Richard, that we're going to see anything material in the form of politics in the short to medium term, which is going to really distort our views on financial markets. Now, keep open-minded. That's been a really good idea throughout this turbulent decade so far. But I mean, I think what we're going to see from the incoming and now in place Labour administration is more of the status quo ante. I liken this election to being one that would probably be one you wanted to lose. The current situation with regards to economic activity in the UK is not great. There's elements of stagnation, I would argue, some pockets of strength, but broadly, the economic mix is not fantastic. Inflation rates in the UK, if you look at some of the observations, are still higher than they are in other parts of the world, and productivity rates aren't great either. Those are symptoms experienced by the rest of the developed world as well. But we've also got a problem with regards to government debt. And as the Labour government takes over, we already have debt to GDP at roughly 100% of debt to GDP. That's normally a sign that the ability to shift the economic dial is going to be hindered by the realities facing the government about where they can spend without potentially adding to our taxes going forward. And there's going to be a bit of that, let's be honest. We just don't know where yet, but I think the signs are pointing towards that. So does the outlook for politics in the UK really shift the outlook for the UK economy? So not the global economy, but for the UK economy, I just don't think it does. I think the outlook for the UK economy is perfectly satisfactory. It's probably solid but unspectacular. But we have to try and hope that there are other global forces and factors which allow us to enjoy a more positive economic environment going forwards. As we sit here today, the political situation does not change the outlook for the UK economy.
Yeah, I fully endorse that. As you know, we've discussed this at length. The Labour government, on the other hand, does have a bizarrely stonking majority, given that they only got 1/3 of the votes, 2/3 of the seats, 211 seat majority or whatever it is. And I think in the past, you've talked about the bond market being the actual opposition to the Labour Party and government, because obviously with the Tories on 120 seats, they're a little way behind. What do you mean by that?
Well, I've learned some new terms recently. I also like that loveless landslide term. That was definitely relevant, given that I think only 20% of the voting population could vote, who voted for the Labour government. So I wouldn't necessarily say it's something which has been embraced and cherished by the UK voting population. But your point about the number of seats they won is obviously relevant for two reasons. First of which, I'm not sure it's going to be as easy for the Labour government to govern as the stonking majority they won might indicate, because with the number of MPs they've got, well over 400, and only 100 ministerial posts, trying to keep your party in order might be a bit more difficult, which is why I think we need to keep open-minded about some of the more extreme policies, particularly around tax, that might get mooted in the future. But for that reason, I think it makes it a bit more difficult for the Labour government to manage the situation than it might have been the case if they had a majority similar to that which Boris Johnson won back in, and the Conservatives won back in 2019. So let's watch that with keen interest. But the simple fact is that there isn't a huge amount of opposition because they've got such a big majority. And you might think in that situation they could probably get away with anything. Yes and no. There might be certain policies that they can wave through, but the reality is, and we learned this, didn't we, in the autumn of 2022 with the short-lived and ill-fated Truss administration, it doesn't matter what your view on the policies announced were at the time. I thought some of them were quite sensible. There's no doubt in my mind that trying to take a different direction might have been a good idea after years of stagnation. I think the PR and the timing of the discussions of these policies were frankly ludicrous. But it did serve up a warning sign and an important lesson for Rachel Reeves and the incoming Labour Treasury that the bond market is massively important. We rely, as a former governor of the Bank of England said, on the kindness of strangers, international creditors who fund our teetering debt pile and will need to keep on financing into the future because, let's be honest about it, no one in the UK is suggesting or indeed voting for a balanced budget. So that means that if we were to see a Labour government that wanted to pursue a policy of unchecked, even more unchecked, spending without the necessary revenue raises from elsewhere. And it's difficult to see where that comes from, isn't it? Because they've already said that 80% of tax levels are sacrosanct, VAT, income tax and national insurance. So if they wanted to spend money on some of their plans, without raising money on the other side of it in the form of taxes and revenues, and we just have to go to the international bond markets to try and raise that debt, then we could see a sort of Trussian incident as we saw in the late part of 2022. Now, I think Rachel Reeves is competent. She certainly comes across as being confident and competent. I think that they would have learned these lessons. And I think this is part of the reason why I just expect the economic experience in the UK to be similar to what it was beforehand. I mean, the Labour government come in talking about change. The front page of the manifesto, change. I'm not sure we're going to see a huge amount of economic change here, if I'm totally honest. What we might see is a few more spending plans met with a few tax rises elsewhere. But ultimately, if they overstep the mark, if they try and spend too much without raising enough money, then the bond market will revolt. And what we learned in 2022, particularly now with debt to GDP of 100%, we haven't got any wiggle room there. So that's why I think the bond market will be the key opposition to any left field, grandiose plans that the Labour government might suggest. So for that reason, as I'll talk about later, we're still pretty sceptical about lending money to any government, particularly the UK government, for any longer than sort of 7 to 10 years. But there's a difference, obviously, between bond markets and equity markets. And we've seen that in part this year. Equity markets have performed extremely well. Bond markets have performed okay, in some places well. But if the outlook for UK assets is mixed, my suspicion is, and I hope you're going to agree with me, I'm pretty sure you will do, that actually the incoming Labour government and a sort of breath of fresh air, even if it's wrong in the medium term, could be good for UK equities. Would that be your view?
Yes, I mean, the UK equities have been highlighted for quite a while as a cheap area of the world market, cheap and very unloved. And people have been casting around for what the catalysts might be to get international investors, but also UK investors, a bit more interested in our market because it is cheap. It's cheap compared particularly with the United States, but also the world and most of our partners elsewhere as well. So, excuse me. What might be those catalysts? The first one is perhaps interest rate cuts, and we talked about that a little bit earlier. I think that will help sentiment. Obviously, that sentiment is shared across the globe, not just in the UK. But I think what will potentially help, and it is down to, perversely, a Labour administration coming in, is a sense of stability for markets in the UK, which, after all, we've not really had from an overseas investor's point of view in a period when we've had 5 prime ministers in a little over 7 years, which is quite Italian in the sense of political turmoil. So having a strong mandate, which looks like it's going to be in place with a single prime minister for the next 4 to 5 years, certainly 5 years, one assumes, might help foreign investors take a slightly less jaundiced view of the UK. Valuation is important, as I say. Interest rates are important. And we do need to highlight that 2 key areas have recently, by which I mean the last 6 months, really begun to change their view of UK assets. The first is UK companies themselves, which are buying back their own equities at record rates. So particularly in the mid-cap area, UK companies are eating themselves, if you like, reducing the amount of equity out there by using their balance sheets to buy their own shares. And the second, most notable in the last 6 months, has been the return of foreign investors, by which I mean foreign companies typically, or private equity investors, to the takeover market in the UK. We've seen a large number of private equity and other takeovers in the UK space, particularly in that SMID space, not exclusively, but particularly in that UK space, because these guys aren't going to wait for the sentiment tide to change. They can see value and they're looking to expose it. So I think actually it's not a bad place to be. And honestly, in the last year or so, the UK hasn't done as badly as you might expect compared with other markets.
What about across the channel? You know, one of the things which is perhaps reassuring at the moment is we're not the only one to be facing political change. I mean, certainly the situation in France looks interesting. Is that something that could become more problematic? Because the effect upon European assets recently has been quite marked, hasn't it? Been quite a marked underperformer in recent times. Is that something which could be a problem? What does it mean for our view on European equities?
I mean, look, Europe, until that surprise European election and following that, Macron's decision to call a snap French parliamentary election, had actually been doing reasonably well over many periods. But you can see how more recently, the orange line is Europe. You can see how recently it's begun to trail the other markets. And that's been because of this political uncertainty, particularly with populism. Now, in many ways, populism of the right and populism of the left has the same impact on financial market sentiment, because both of those wings of populism are looking to escape from the shackles of the international debt markets, be a little bit more Trussian, as you said. So markets were worried that the French right would do better because they were saying lots of things about not following the fiscal sustainability rules of the EU, about potentially questioning their membership of the EU, and about restructuring things in a quite destructive to a consensus way. So the less good performance in the actual election in France of the right has caused perhaps a slight sigh of relief. But we mustn't think that that move rightwards in Europe has gone away. We still see in Germany, in Italy, in Spain, and in France itself, of course, and Holland, lots of momentum towards the right. And let's not pretend that the UK, having elected a Labour government, has actually bucked that trend, because we all saw the large vote share that Reform got, which very much falls within that spectrum. So I don't think that problem's gone away. It's a headwind to Europe economically, but let's also be aware that rather like the UK, the largest European companies are very international and tend to be less exposed to those kind of domestic economic issues than you might imagine.
And I'm sure lots of people who've dialed into previous webinars will say that this chart in front of us looks a little bit familiar, doesn't it? The light blue line being the US equity market has continued to power ahead. And, that's really been a symptom of financial markets now, Richard, for, the last 15 years since the great financial crisis era. What do you put this down to? I mean, is this some indication of what might happen in the US election coming up, or is it something else which is driving this continued and persistent outperformance of US equities?
Yes, the US market is two markets in one. There are 490 odd companies in the S&P 500, which perform very similarly to the companies that we've got in Europe and the UK. Let me give you some numbers, which have not put on these charts, but I updated these this morning. If you look at the position over 2 years, the S&P equal weighted index, where every member of the 500 constituents is given an equal weight, 0.2% each, is up 16.9% over 2 years. The actual S&P is up just under 40%, 40%. So you can see there's a very marked difference there. And if I look at NASDAQ, which is a measure, an index primarily of technology and biotech companies, that over that 2 years is up 54%. And the most extreme example of this, coming to this chart, is NVIDIA. NVIDIA is now one of the 3 largest companies in the world, well over 3% of the global index, very similar size to Microsoft and Apple. In fact, briefly last month, it grew to be slightly bigger than them. NVIDIA over 2 years is up 725%. Just to illustrate how concentrated the market has been. If I go back 5 years, NVIDIA is up 3,080%, an enormous growth. So you have to make a call on these very, very small number of companies, the so-called Magnificent Seven. There are, in fact, as I say, around 10 of them, but the Magnificent Seven sounds good. And most recently, in May and June, we saw a reversion to what I think is a relatively unhealthy market trend, which is big concentration of returns in those names, particularly NVIDIA, as you can see. Whereas for the previous 6 months or so, we've seen a much healthier broadening out of the market. If we get the interest rate cuts we expect, and a degree of political stability, because let's face it, the US faces political instability of its own, then I think we can see the market broadening out, and that will be good news for portfolios, because it's quite difficult to buy a stock which is up 3,100% over 5 years and which looks expensive. So from a long-term view, it makes the job of investors like us for our clients much, much more complicated. I'm looking forward to a broader market like we saw earlier on this year.
Yeah, and of course, have seen in the past. This is a relatively new phenomenon, isn't it, Richard? This sort of, the big companies almost eating the rest of the index. And that partly goes down to the fact that they've been wonderfully successful companies, and we should never forget that. They've done well for valid reasons. But there is really a good case to be made for the market broadening out, particularly as we see at the moment earnings estimates for the companies outside of the Magnificent Seven also starting to improve. And that should give equity investors confidence as we move deeper into the second half of the year. It's quite a rare phenomenon, actually, isn't it, to see estimate upgrades for earnings at this time of the year. Normally people are marking those earnings down. And that is a pillar of support, we believe, for equities in the second half of the year. But playing devil's advocate, we've seen the market being so concentrated recently, and those small number of big companies so dominant in the index now. If the market broadens out, it could be a period when perhaps active equity investment does well, even if the overall index doesn't. So it might mean for equity indices, we might have seen the best of the returns this year already, but there's still good money to be made in equities. Or am I missing the point?
No, I fully concur. I think you might well see the broadening out I talked about, but because the top 7 or 10 names have done so well, we could see some declines, not massive declines, but we could see some declines in those names. And those names in global equity terms are over 20% of the index. So you can see how the broadening out might have a headwind at the the broader index level. And I think that there is room for other assets to do better in the second half. Don't get me wrong. I think, as you said, these companies, these Magnificent Seven, are superb companies in the main. Not all of them, but pretty much the big majority. Superb companies, very cash generative, very financially solid, very strong intellectual property, protecting their margins. So they're great companies, but possibly a little bit rich. So I could quite easily see the market tracking sideways or only up a little bit in the second half of the year as we go forward. And I guess that brings me on to flipping the question, because we've been well positioned in fixed income, but fixed income as a market has been a bit disappointing in the first half of the year. We've done better than the market in that space, as I say. So is there room for fixed income to add impetus to portfolios in H2 when equities perhaps take a pause?
Well, we've talked about cricket and football already. Let's switch tack to cycling. I think there's a very decent case that the yellow jersey will be worn by fixed interest for the rest of this year. We must go back to the start of the year, and we did say that there would be money to be made in fixed interest markets. Broadly, fixed interest markets are pretty insipid this year, actually. Some are down, some are flat. But as you kindly pointed out, the fixed interest allocations that we've run have made decent positive returns. My suspicion is, in the second half of the year, that we will see a period which is much more conducive to overall fixed interest markets performing well, for a few reasons. I mean, first of all, what we might see is more of the opposite of what we saw in 2022, which, as a lot of you will painfully remember, was just about the worst year on record for broad fixed interest markets. Back then, inflation was a problem. You remember back in 2021, listening to the masters of the financial universe, the central banks, talking about transitory inflation. This wasn't going to be a problem. Interest rates wouldn't need to go up. Inflation was going to come down very quickly. That transitory inflation became persistently transitory inflation, and then obviously permanently transitory inflation. It was with us for a few years. But that inflation is now starting to come down. Maybe the central banks weren't completely wrong. Maybe it was transitory after all. So we are seeing a disinflationary situation, which is good for fixed interest. I'd likened before inflation being to bond markets what kryptonite is to Superman. It is a sapping influence upon the power of the returns of fixed interest markets. As inflation comes down, that should be good, which on the right-hand side of this chart should lead to interest rate cuts. Now, what you'll remember from the end of last year, if you read any of our commentary or listened to one of these webinars, was that the market got really excited about the prospect of 6 or 7 interest rate cuts in the US by the end of January 2025. Well, the central bank better get a move on because they haven't cut rates at all yet. And we never expected that. But we believe the next move in interest rates will be down. That still looks to be true. And we expect it to be around the summer. Bear with me, give me some wiggle room. Let's assume that the summer actually does finally arrive for a start. But let's assume that September is still the summer. I think by the time we get to September, both the Monetary Policy Committee of the Bank of England and the US Federal Reserve will be starting to lower interest rates. Just as these two factors, inflation and interest rates, were a problem for bond markets in 2022, the opposite here might be the case. So a combination of those two big macroeconomic factors, and also if the economic activity is slowing, that's not a problem for bond markets. It might make it more difficult for companies to make money. Well, I'm not really interested in that. All I'm really interested in is, can governments and companies pay me back the money that they borrowed? And I don't see anything in the economic mix which is going to upset that. So in very simple terms, inflation should be good for bonds. Interest rates coming down should be good for bonds. Economic activity being solid but unspectacular, rather sort of stagnant, that's perfectly fine for bonds. And still an expectation that corporate insolvencies aren't going to pick up markedly. They will pick up, but they won't pick up markedly. You know, that all was pretty well for bond markets. So my suspicions are, and I hope that we can carry on adding extra value or alpha through fixed interest in the second half of the year, but we're going to be doing it with a tailwind or better bond market performance rather than the headwind, crosswind that we've seen this year, where bond markets have pretty much gone nowhere.
That sounds very encouraging, because we do want to keep the improvement we've seen in the last 9 or so months in client portfolios going, of course.
We're very keen to see that. Absolutely, yeah.
Absolutely. We don't want to be at the tail end of a sacking. But let's draw it all together. Where does this leave our asset allocation positioning for standard client portfolios?
Yeah, I think broadly, still cautiously optimistic. And as people who've suffered me for the 20 years that I've been investing will recognise that the term cautious might have been often more relevant than the term optimistic. But at the moment, things to us seem to be about right. In terms of the valuations which we're paying or the compensation that investors are getting for making the investments they're making. And sometimes these things do become significantly out of whack. There have been times in the last 20 years when asset markets look very cheap. And I wouldn't say that's now. I think we'd be treating our clients as being naive if we were to suggest that things were outlandishly cheap. They're just not. I think at the same time, there's been times, the most recent of which at the end of 2021, when things look out of whack from the other perspective. Things look very much overpriced, even if hindsight's a wonderful tool to make such a statement as that. But at the moment, things look to be about right. I mean, let's just think about the fixed interest complex once more. Bond markets, in very simple parlance. At the end of 2021, the range of investment opportunities you had in government bond markets was anywhere between 0 for the yield on a government bond out to perhaps 4 or 5% for taking quite extreme risk, quite significant risk of default with some more spurious borrowers or creditors and lending money to them. As we sit here today, those rates of return between 0, let's just say 5, have gone to 4 to 4.5, up to about 10. So you've seen a significant repricing of bond markets into investors' favours. That's important because if bond markets can churn out stable, positive, unexciting returns, then that's great for the outlook for portfolios. Now, there are risks still out there. Could inflation pick up once again? Yes. Could we be wrong on interest rates? Yes. Could the economic situation be different to what we're projecting? Absolutely. Could we see a rise in corporate defaults in the future that we're not currently forecasting? Absolutely. So do I want to, at this point in time, be ridiculously or extremely overweight fixed interest markets? No, I think being neutral, cautiously optimistic, in some cases positive, is appropriate. When it comes to equities, as you said earlier, we're in a situation where valuations are neither extreme on the positive side or the negative side. I think you can make a case that equity valuations are broadly fair. There are some parts of the world where I think we very much agree. The US market looks to be expensive, but sort of quote the Stella Artois advert, maybe it's reassuringly expensive because those companies have done well. On the other side of that, you have to say that lots of markets, the UK being one of them, I would say Asia being another, Europe being another, they all look to us to be pretty attractive at this point in time. And I think you would look at the situation on global equity valuations and say again, and it might not sound particularly exciting to say, but they seem to us to be about right. So there's a big case to be made for being neutral in fixed interest and neutral in equities. And what that means in the alternative space, which has become very popular in the wealth management space, we just don't need to take lots of alternative risk elsewhere when the two main building blocks of client portfolios are about right and valuations are fair. So to put it together, it might sound very boring to say that we are neutral or in line with clients' strategic asset allocations, but rather take that as a statement of cowardice, maybe take that as a statement of confidence. We believe that things are about right, and that will be conducive to making positive returns. Now, ultimately, there will be things, as we're showing here on the conclusion slide, which is going to create volatility as we go forwards. Political events will create short-term volatility, even if we would advise people to ignore it from the long run. The geopolitical framework is undoubtedly complicated and getting more complicated every single month. The war in Ukraine tragically still rages on. The situation between the US and China is unstable at best. And around the world, we're seeing a fragmentation of the post-Second World War backdrop for geopolitics, which is leading to increasing splinters and groups of allies and more conflict, as we're seeing all around the world at the same time. These situations will create volatility for markets. But history has told us that you should ignore situations like that, unless we see World War III, of course. But let's put those most extreme situations to one side and focus in on the fundamentals. The fundamentals as we sit here today are economic activity for the next few months and quarters looks like it will be okay. Nothing more than that, but it will be okay. Inflation rates are starting to come down. Yes, they could pick up again in the future, but for the time being, that does give a green light to central banks to cut interest rates, and typically that's good for many asset markets. So those three economic fundamental pillars are currently supportive. Let's then think about the sort of corporate fundamentals or the microeconomics that we're currently facing. I think, Richard, we sit here, in meetings on asset allocation and point towards the fact that global corporate earnings are growing, margins are widening, the outlook is being raised rather than being decreased at this juncture, and all these things can change. But for the time being, that's what's in front of us. So finally, just on sentiment and to extrapolate out a bit more on that about right comment on asset valuations, there's been so many times when we've worked, and I've invested for 20 years, and I don't know how long you've invested, Richard, but some time longer than that, when things have been extreme. They're not extreme at the moment, neither in terms of valuations nor in terms of sentiment. So on that basis, we would expect the outlook for asset markets to be okay, satisfactory. And I think that's really the message from today. Just as the world becomes increasingly complicated, and we are undoubtedly living in a decade that was rightly termed the turbulent 20s 5 long years ago, that doesn't mean that the outlook for financial markets is necessarily worrying or poor. We would argue, actually, the outlook for financial markets is still positive, and we believe that the continuation of the recovery that we've seen in portfolio values since the end of 2022 should continue for the rest of this year. Now, open-minded is absolutely the right approach. We'll reevaluate 2025 as we come towards it. But I think for now, whilst a correction or a consolidation in markets and portfolio valuations is always possible, I think we still feel confident rather than complacent that we can achieve our clients' aims.
Thanks, Tommy. I want to move on to questions because I'm acutely aware that we don't want to take up too much of our clients' valuable time. But just to reiterate that we may be wrong. We are, however, flexible in our approach. So we're well positioned if things change, if events change, to change our views accordingly. So just be aware of that, both if things get worse than we expect, because really this is quite a positive outlook, a cautiously positive outlook. If things get worse, we've got the flexibility to move, and we've got some insurance policies in place to help us in that event in portfolios. And similarly, if things get much better for one asset class or the other, we're also positioned to move. So we're in a nice position there. So let me move on to questions, and please keep the questions coming through. I think it's questions@canaccord.com is the address. We'll try and cover the main questions that have come through and group them together. If we don't get round to answering your question, one of our colleagues will come back to you with a reply after this. And I should say as well, there'll be a recording of this webinar available in a few days' time as well. First question that we've had come through, probably for me, Tom, is about UK small companies, and particularly whether the change in the UK government will have an impact on the AIM market through the transmission mechanism of changes to the IHT tax regime. It's a very, very tricky question to answer. It's a very good question. The valuation of the popular IHT stocks within AIM is significantly higher than other AIM stocks and other small companies which are similar to those AIM stocks, which aren't in AIM itself. So there is a fear that were inheritance tax to be significantly reformed, if the exemption that IHT portfolios provide under the right circumstances from inheritance tax to be taken away by the Labour government, that this might have a bad impact on the AIM market. That's true. That might have that impact. The challenge that the Labour administration have, and let's be frank, they haven't nailed their colours to the mast about inheritance tax. It's one of the 20% of the tax base they haven't identified as being sacrosanct. The challenge for the Labour government is that they also want to support the UK capital markets. And And they've been overt about that. They've been absolutely clear, just like the Conservative government was before them. They're acutely aware that the UK capital markets, particularly in equities, have been weak over the last 20 years, and that has contributed to the poor productivity track record of our country. So, sure, they might want to do something about inheritance tax, but doing something which would significantly penalise the most dynamic part of the small companies and the capital markets in the UK would be perverse. So I can't guarantee that, but we should bear that in mind. So I'm marginally optimistic that we won't see too much turbulence in that area. And again, the Labour Party has talked a little bit about whether they would support the concept of a British ISA, investing in specifically British companies. They, as I say, they have spoken in support of the concept. To damage the UK capital markets and do that at the same time would be quite a perverse thing to do. So I think they'll have to tread very carefully. Rather, as the bond markets are their opposition, they're also going to have to keep an eye on the UK equity markets. Tom, I'm going to stop going on about that one and pass a question over to you. We did mention that our fixed income selections have been have been rather better than the market itself. I've had a question to ask about what areas of the fixed income market have we identified that are doing so much better at the moment?
Yeah, and I think when I mention things it's very easy to talk about things which have done well looking backwards. The much more difficult question is to say what might do well going forwards. But I think that there is a continuation of the themes in our clients' fixed interest allocations that we still absolutely believe in. Despite the fact inflation is coming down, I think buying some inflation insurance through inflation-linked bonds, particularly those of a short duration nature, so shorter maturity because you've got more predictability, I think that remains sensible. Inflation insurance is still moderately cheap. Having some now, I think, remains appropriate, just in case. As we've seen in previous inflationary cycles, there's a first wave, things calm down, everyone gets relaxed, and then things pick up once again. So that's one element that we continue to look towards. The other thing that we would focus on is that we actually now are much more warm to government bond risk with a major caveat. And that goes back to my point that we're happy to lend money to governments, most governments, but not for very long. Because the ability for us to predict 10 months out from now is quite difficult. Trying to predict 10 years out from now is almost impossible. Imagine sitting down in 2014 and predicting where we'd end up now. But with regards to the economy and indeed the England football team, to be perfectly honest, it's very difficult to predict that far in the future. And I think there's a lot of uncertainty over government's taxation and spending plans and inflation over the long run, so we'd avoid that. So instead, we're focusing on areas of specific corporate credit, where we're being very selective. Those companies which can survive a questionable, uncertain economic outlook, and where they're currently paying us attractive rates of income or interest for lending them money. And the good news is there's still lots of areas in which you can do that, but you need to be very selective. The biggest change in the last 10 years has been the movement higher that we've seen in interest rates from the last decade to where we are now. In the last decade, there was no need to be a good company or a bad company. You could be anything. Didn't matter. You could borrow money for free. That's now changed. The movement higher in interest rates and in borrowing costs will mean that while good companies can still flourish and survive, bad companies can wither and default. That's why we're being very selective. So for those three things, that's what we'll be identifying the richest source of success over the last couple of years and what we expect to continue delivering in the future.
Thanks, Tom. That's very clear. Another one for you, because I know you're very eloquent on the subject. And
this is questionable.
We've had a couple of questions about the US, and I'm going to encapsulate them into a single question, which is Trump bad for US assets?
Excellent. Well, thank you for that one. I thought we were friends. It's a very good question, and I'm going to have to answer it because we should always have a view. but I think you have to give me some more wiggle room here and accept my caveats. So do I think that a Trump presidency is now likely? Yes. Should we be preparing for it in portfolios? Yes. Is it going to make a major difference to our asset allocation? No, because I think that we're already quite well positioned for this situation that we are viewed as being likely now for some time to come. Doesn't matter which side of the political spectrum you sit on. I find myself increasingly apolitical, but you have to recognise that President Biden has not been popular, and his policies, regardless of your views on them, have also not been particularly popular with the electorate. As we sit here today, I would suggest that betting markets have it right for the situations we sit here today, that Trump will be the next president of the US again in November, and obviously the start of next year. In terms of asset markets, I mean, Trump was positive for equities, and I think he'll be being perceived as being positive for equities because he's likely to pursue a relatively reckless, but let's be honest about it, all the last few governments, in particular the Biden administration, have been reckless with US government fiscal policies. But Trump is likely to extend the corporate tax cuts and the various other tax cuts, which are looking to be rolled over. And I think the perception will be that that will be good for corporate profits, and that will therefore be good for equities. And whilst they might not admit to it, I think a lot of the US corporate sector would be hoping for a Trump victory because it will boost their profitability in very simple terms. Now, the other side of the equation, just as we talked about with the Labour government in the UK, less revenues, lots of spending. I mean, your choice in the US is really between two quite questionable elder gentlemen who want to spend $6 trillion the US government hasn't got in different ways. I mean, that's broadly your choice at this point in time. If the Trump administration coming in doesn't find ways to offset the lax approach to tax revenues, i.e. cutting spending, which no one's voting for in the US or any other developed economy, despite the fact we might need to do that in the future, I think that could create a lot of volatility in the bond market, particularly in longer maturity government bonds, which brings us back to the fixed interest allocations we've got of being very precise, very selective, and short duration, so we're not taking that volatility or interest rate risk out into the future. You don't need to, and there are ways to mitigate against it. So in terms of Trump 2.0, is it fair to say he could be positive for equities and bad for bonds, long duration government bonds? I think there is absolutely a case to be made for that, yes.
Thanks, Tom. I think there's time for just one more, and I'm going to stick with politics, and I'll let you off this time, Tom.
Thank you.
Pick this one up myself. A question's come through asking, is Europe finished? So this is a very good question. I discussed a little bit earlier about the lurch to the right we've seen, the rise of populism in what you would have thought 10 years ago were very forward-looking, enlightened and very liberal European countries like the Netherlands, like Sweden, for example. We've got to be careful when we think of Europe from this side of the channel, however, because there's a definite tendency within Britain, England particularly, and the city, I would say, for people to view Europe as a strange construct that is doomed to failure because we just a little bit like it to fail. And in 2011, they had a good go at it. If you remember, Greece was bailed out and had to go through the most horrible austerity measures to stay within the EU. And we've seen more and more measures to sort of federalize the broader EU debt step by step, which makes it more and more difficult for the North, which is more fiscally prudent, to accept the more profligate South. And these create massive tensions at a time when populism driven by income inequality, etc., absolutely wants to break free from this kind of structure. But even given that, we mustn't forget the depth of commitment to the concept. When we're talking about Europe, I'm really talking about the EU here, the depth of commitment to the EU in that core and the desire to keep it together and on that path. I think it will take a lot longer than just the next 5 years for Europe to be finished. And as I said earlier, I would also pour a little bit of oil on those waters by pointing out that a lot of European companies are not very European at all. They're very international. So I think Europe may have a difficult 10 to 15, 20 years ahead of it, but in the next 5, I don't think it's going to cause too much of a problem for European asset markets. Well, I hope that's interesting. As I say, we have some questions we don't have time to answer, and we will ensure that those are answered individually by email to those who have asked them. And thank you so much for those. It just remains for me to wish you all very well for the rest of the summer. We all obviously wish England well on Sunday in Berlin, but also we wish everyone a successful and profitable second half to the year in an environment where Tom and I are pretty confident we're going to see some decent but not overly spectacular returns in your portfolios. Thank you very much.
Thank you.